Okay, let's get started, folks. So, why is understanding long-term care and how it may apply to you so important? Well, to completely wrap your head around the answer to that question, you first have to understand what the state of affairs is in the U.S. when it comes to long-term care and where that may be leading us at the moment. Did you know that Medicaid, which is a joint health program for low-income individuals that is funded jointly by our federal and state governments, spent approximately $135.8 billion on long-term care services in 2020, which was an increase of around $6 billion over the previous year. And California, New York, and our very own state of Pennsylvania were the states with the highest long-term care expenditures. So, since Medicaid accounted for 7% or $462 billion of all federal outlays in 2020, that means that long-term care made up 1/3 of the federal Medicaid budget last year, and most likely a larger percentage of each state's Medicaid budget as well, since our federal government covers up to 60% of all nursing home residents and roughly 50% of all costs for long-term care services and supports in each state. So where is all this leading to? Well, some states have found that the cost of long-term care has gotten to be so burdensome on state budgets that they've actually created a new tax to fund it. In fact, in Washington state, legislators approved a public long-term care insurance program in 2019 that would be paid for by an annual payroll tax surcharge of 0.58% of each worker's wage. In return for this tax, each person who paid in would be eligible for public long-term care insurance benefits of up to $36,500 per year that would begin in 2025. However, there was one caveat that they made at the last minute where they changed the law so that residents could opt out of having to pay the tax if they purchased private long-term care coverage by November 1st, 2021. Also, according to an article dated November 1st, 2021, the beginning of this month, it's the last day of the month, on the long-term care news website, there are currently 12 other states that are considering implementing a long-term care tax, very similar to the one that was passed and will go into effect in January 2022 in Washington state. Now, currently PA is, fortunately for us, not on that list, but New Jersey is. But you can certainly see how it's a possibility for all of us to have to seriously consider private long-term care coverage in the not too distant future. And all of this is not even to mention that the Medicaid income and asset rules, if you need the public long-term care coverage, could definitely cause hardship to your spouse and your heirs under certain circumstances, which we'll discuss in detail in a minute. But before we do that, I want to thank each of you for attending our webinar today. Our topic is understanding long-term care and how it may apply to you. And my name is Brian Dougherty of PLC Financial Solutions, and I'm your host along with my beautiful, wonderful partner in business, Rachel Dougherty. Say hi, Rachel. See, Rachel will be our moderator for it. She's going to be handling all your comments and questions as we move along. Also, folks, I must tell you that we're just so excited to be presenting this extremely important topic to you. It's been quite a while now that long-term care has been of special interest to us because we feel like so many retirement plans can and have been derailed as a result of catastrophic long-term care events for so many people in our country. But before we get started, let's take care of some general housekeeping first. Number one, if the screen is not big enough for you, you can click on the View Options drop-down at the top right of your screen. Just move your cursor around. Click on that, and you can follow that drop-down, and you can make your screen larger. Two, also, you'll see that there are two boxes at the bottom of your screen. One's called Chat, and it's for your comments, and another called Q&A, and that's for, of course, your questions. Please use them accordingly, and Rachel will respond in kind. I'm sure that many of also have questions on this material that we're going to be covering today, but since we have a good bit of material to cover and only an hour to cover it, I'm going to ask you to put your comments and questions in those boxes below, and at the end, we'll be staying for some extra time to cover as many of them as possible. However, if we don't cover yours, we'd be happy to answer it by either email or even in a 15-minute Q&A, phone call, or Zoom meeting that we could schedule for another time. And Rachel's going to be putting that link up at the end as well. Next thing, this webinar is being recorded and it will be sent to everyone who is attending tonight. So don't worry about missing anything. You'll have plenty of time to check it all out again at your convenience. Also, because we want to make sure that you're all paying attention and because we'd like you to have some fun as well, before we answer any questions at the end, we have a 6-question quiz for you at the end. And the first person to answer each question correctly inside the comment box will win a $10 gift card to a store of your choice. So make sure you have a notebook handy and to jot down some brief notes related to some special bullet points that I'll point out as we go along. Finally, it's our obligation as a financial advisor and a fiduciary to inform you of our RIA's disclaimer statement, which is that our investment advisory services are offered through Fusion Capital Management, an SEC registered investment advisor, and we only transact business in states where we're properly registered or are excluded or exempted from registration requirements. And SEC registration is not an endorsement of the firm by the commission and does not mean that our advisors have attained a specific level of skill or ability. And most importantly, all investment strategies have a potential for profit or loss. So now that we got that out of the way, I have one for you, as always. What did the circle say to the triangle when he told them that he had no point to him? He said, "That's how I roll." I just got that one from my son Case just last week. I figured I needed a fresh one. I told you I was going to use it, Rach, right? All right, so now let's jump in. So, how likely are you to need long-term care? Well, even though it can vary over time dramatically and continues to change over time, here are some statistics to consider. Someone turning 65 today has almost a 70% chance of needing some type of long-term care services and supports in their remaining years. 53% of women and 47% of men will need long-term care in their lifetime. Women need long-term care about 3.7 years and men about 2.2 years. While 1/3 of today's 65-year-olds may never need long-term care support, 20% will need it for longer than 5 years. So if I told you that you had a 70% chance to win in one casino and a 30% chance to win in another, which one would you choose? That's a silly question, right? Absolutely. So let's look at some facts related to the different types of elderly care that are available today. So home-based care. So one of the types of home-based care that's available is called homemaker services. Nationally, the median daily rate charged by a non-certified but licensed home care agency for homemaker services is $141. Homemaker services include things like housekeeping, cooking, and running errands. Now, home health aid services, nationally, the median daily rate charged for a non-certified but licensed home care provider for home health aid services is $144 a day. Now, home health aides provide assistance with activities of daily living, aka ADLs, but not medical care. Now, community-based care, like adult day health care. Nationally, the median daily rate charged for an adult day health care, which provides therapeutic, social, and other support services in a community-based setting, is $75 a day. Now, facility-based care. Now, the first type is assisted living facilities. Nationally, the monthly median rate for a private one-bedroom unit in an assisted living facility is $4,050, which is an average annual cost of about $48,600. These rates exclude one-time community or interest fees. Then there's actual nursing homes. Nationally, the median annual rate for a single occupant private room is $102,200 per year, or $8,517 per month. The median annual rate for a semi-private room is $90,155 per year, or $7,513 per month. Considering the average length of stay in a nursing home is 2.5 years, the total cost for an average stay today would be about $225,000, up to as much as $255,000. Now, for many, this expense could easily consume a lifetime of savings. Others may not be able to even cover all the costs at all. Also, according to this, the Genware study that provided these statistics also tracked the historic trends of these costs, which in general tend to increase each year. Based on these historical trends, it's possible that the cost of the most expensive levels of long-term care will, in 15 years or so, be roughly 1.5 times what they are today. So there is definitely an inflation with this type of care, and it will be going up. So if someone who is in need of long-term care services today is either unconfident that they're going to be able to afford the cost of long-term care, or originally thought that they could, but started to think that they are going to run out of money as a result of their needs, then they're going to need to file a claim with Medicaid. And then they're going to need to start playing by Medicaid's rules. And the first rule that most people will be introduced to is called the spend down rule. And there are 2 main clauses in their rules that explain or define how this works. Medicaid's long-term spend down rule, clause 1, actually has 2 parts to it, and they go like this. Part 1, since Medicaid is the largest public source of funding for long-term care in the United States and is funded and administered through federal and state efforts, contrary to many people's beliefs, when it comes to long-term care, Medicaid is not available for everyone who needs long-term care services. It's available only to certain low-income individuals and families who fit into particular eligibility groups. Those who applied to Medicaid for payment of long-term care services must meet both the financial and functional eligibility criteria to qualify. The financial criteria to qualify often requires recipients to spend down their assets to become what Medicaid considers to be sufficiently needy. So, now part 2 does, however, mention that there are rules that allow preserving assets for healthy spouses to prevent spousal impoverishment, which we'll discuss in a few minutes as well. So, as you can see, folks, Medicaid does not look at things as they relate to the individual in need when it comes to who's responsible to pay for these needed services. They look at it as a family responsibility. So when people, when a loved one becomes the applicant for this, it's not just them on the line for it, it's the family. Let's dig a little deeper when it comes to that. So what does it take for Medicaid to consider you to be medically needy? Well, you have to meet 3 criteria. The first is you must belong to a group that your state has defined as a Medicaid eligible group. Categorically needy or medically needy are 2 examples. So you must have a medical or functional need. Either an impairment that limits your ability to perform activities of daily living, and require either institutionalized care or the level of care given in an institution, but are able to receive it in the home and or in the community. And the third, your income and assets must be at or below specified levels. These levels vary depending on which eligibility group you're in and where the long-term care is received, in the home or community or in a nursing facility. However, regardless of these variables, the financial requirements that apply to Medicaid coverage for long-term care services are strict and may subject individuals to divert the bulk of their income to the cost of their care and must spend down the majority of their assets to the point of being considered impoverished. Medicaid considers this to be a process of what they call self-impoverishment. Now, I don't know about you guys, but I don't particularly care for those 2 words in combination. I'm okay with them separately, but not so much together. The idea of self-impoverishment somehow goes against all that I've worked for my entire life, and I want no parts of it. And if I can avoid, at least if I can avoid it, I'm sure most of you would concur with that as well. So, what is the process of what Medicaid calls spend down? Well, it's the process of depleting private or personal resources in order to become eligible for Medicaid. Thus, entering a nursing home or obtaining long-term care service by initially paying the costs out of pocket until you essentially run out of money. Then you can apply for Medicaid once you've depleted all your resources to the point of meeting the Medicaid eligibility requirements, which will place you and your spouse at the government poverty level. As you can see, folks, this is some serious stuff and should be given deep consideration far in advance in order to avoid these circumstances as much as possible. So let's look at Clause 2 of the Medicaid spend down rules. It breaks down the bottom line when it comes to who Medicaid long-term care benefits are intended for in 3 simple sentences. First, it's for those with low incomes. Second, it's for those who incur catastrophic medical expenditures. And finally, It's for those with minimal assets. In short, this means that to be an eligible recipient, you must meet 3 basic qualifications. First, your income, both individually and the spouses as well, cannot exceed certain limits. Second, your medical expenses have to be beyond your ability to pay for it. And finally, you have to spend down your assets on medical or long-term care, on your medical or long-term care needs, to the point of self-impoverishment, which Medicaid clearly defines. Okay, let's get a little more granular when it comes to the details related to the income and asset limits for both Medicaid applicants and their non-applicant spouses, also referred to by Medicaid as the community spouse. So these are the Medicaid long-term care income rules for the applicant spouse. First, you must divert the bulk of your income to the cost of your care. Second, in most states, your income must be at or lower than 300 times the supplemental security income, also known as SSI, income limit to qualify, which is currently $749 or $794 a month, and you times 3, which comes to $2,382. So a Medicaid applicant can have an income level to qualify more than, in 2021, more than $2,382 a month. Now, third, you must contribute almost all available income towards the cost of care for Medicaid to pay the rest. And finally, you'll only be permitted to retain a nominal amount of your income each month. And get this, that nominal amount is somewhere between $30 and $50 a month. Who in the could possibly, what can that get you in a month's time? These are kind of archaic. I believe these rules need to be updated at some point. As you can see, these income rules are pretty strict and don't leave much for anything or anyone else. Now, what types of income does Medicaid count towards eligibility? In other words, what are the types of income that must go towards paying for your medical needs? Well, it covers most type of income, as you can see. Wages, although there are certain deductions that are allowed. Investment interest, investment income, that's interest and dividends from savings and investments. Social Security benefits, veterans benefits, pensions, IRA income, and rental income. Now, what's the income that is not counted towards eligibility? Well, when you look at these, you can pretty much understand right away why these aren't counted. The first is temporary aid to needy families, the program that replaced aid to families with dependent children. The second is supplemental security income. This is like Social Security for impoverished people, and it many times covers people with disabilities or handicaps as well, but can't qualify for Social Security disability. Food stamps, low income home energy assistance, program benefits, a program that helps pay the heating and cooling bills of low income and elderly people, foster care payments, certain housing or utility subsidies. So as you can see, if they did count this income, they would pretty much be adding insult to injury. So I don't think there are any surprises when it comes to this. Now, they were the income rules for the applicant spouse. Now let's look at the rules for the non-applicant spouse, or the community spouse, or the spouse that's not applying for Medicaid. The first, federal law permits the community spouse to maintain a higher income for support called a monthly maintenance needs allowance, or another one of those fancy acronyms that they like to use, the government, the MMNA. I'm sure you're going to remember that. In 2020, community spouses can keep at least $2,114 month of their monthly income, or up to a maximum of $3,216 at the state's option or discretion. Essentially, between 200 and 300% of the federal poverty line level. Any income the community spouse receives in their own name, Social Security, pensions, or dividend income, for example, may be retained fully by the community spouse. So there is some income sources that the non-applicant spouse can keep that's just in their name. Now, no portion of the community spouse's own income is required to be assigned to Medicaid or diverted to cover the cost of care for the institutionalized spouse. So no portion is, but they do have certain limits just to qualify for your spouse to receive it. In other words, you can't be receiving $20,000 a month pension and still meet and have your spouse still meet the qualifications. It has limits to it, but they're not going to try to go after it if it's in your name. So that covers all the income rules for both the applicant and non-applicant spouses. Now let's look at the details related to both them as it pertains to their assets. So here are the rules for Medicaid's long-term care spend down on assets. First, all money and any property that can be valued and turned into cash is a countable asset unless it is specifically exempt. We're going to go over what the exempt assets are in a minute. If the value of total countable assets exceeds the Medicaid eligibility limit, the applicant must spend down these assets to the limit before Medicaid assistance is available. Now, finally, certain allowances are made for married couples that enable a community spouse to retain countable assets up to a certain limit, and we'll discuss them in a minute. So what exactly is Medicaid's asset/resource requirement or limit for an applicant spouse? Well, brace yourself, because it's pretty bare bones. They're not allowed, they're not permitted to have any more than $2,000, or this is verbatim, or $3,000 in countable assets to be eligible. Now, I'm still trying to figure out whether it's 2,000 or 3,000 and how they determine which it is. But either way, it's like splitting hairs when someone gets down to that low in assets, and with an allowable income limit of only $30 to $50 a month, I don't think that these assets will be lasting very long anyway. So it just goes to show you how Medicaid really is not joking, especially when it comes to assets. They're much more generous when it comes to income. So here are what Medicaid considers countable or non-exempt assets. Again, meaning that these types of assets must be used to spend down on an applicant's medical needs. Again, there seems to be no surprises on this list either. Cash, checking and savings accounts, certificates of deposit and money market accounts, stocks, mutual funds, bonds, and other investment holdings, IRAs, KIOs, and other retirement funds, non-resident property, you name it, they're taking it. Okay. So here are the non-countable or exempt assets. And as you can see, they leave no stone unturned either. Primary residence. Now, in Medicaid long-term care applicants, principal home is exempt as long as the equity value in the home is less than $500,000 or up to $750,000 at the state's option. The exempt value of the primary residence is unlimited if the applicant has certain family members living there, such as a spouse, a child or children under age 21, or a blind or permanently disabled child. Now, an automobile, so you get one car of any value is exempt if it's used by a household member. Household belongings, including furniture, appliances, and other similar type items, and personal possessions, including jewelry, clothing, and similar items. Now, these are a couple that really talk about splitting hairs. Burial contracts are exempt. Well, kind of. So if it's an irrevocable burial contract with a value of $5,500 or less, or for a revocable contract with a value of $1,500 or less. However, the value of the burial contracts that are up to each is actually up to each state individually. In many states, the value of the burial contracts must be reduced by the cash value of any life insurance policies. So basically, they're taking it out of your cash value. Now, a burial plot for the applicant and immediate family includes the purchase or prepayment of the following items. They're really splitting hairs here. A grave site, opening and closing of a grave site, a cremation urn, a casket, any outer burial container, headstone, or marker. Cash value of a life insurance policy, get this one, is exempt as long as it does not exceed $1,500 to $3,000. That's a pretty small life insurance policy, folks. So it's, in essence, including even the cash value in a life insurance policy. So as you can see, Medicaid is pretty granular when it comes to what they count and what they do not count. However, I'm not too sure how they would go about getting the excess value of a burial contract from the applicant. But I am sure they must have some way to go about it or it wouldn't be on the list. Now, let's talk about the spousal rules as it pertains to assets. The community spouses can retain half or even more of the couple's combined assets, subject to state and federal minimum and maximum limits. All states must allow the community spouse to keep all countable assets up to a certain minimum of $25,728 as of 2020, and up to half of the assets if they exceed this limit, up to a maximum amount of $128,640. So in essence, what they're saying here is the most they're going to allow a non-applicant spouse to keep is $128,640. Now, if you were saving your whole life, and I have clients that far exceed this amount, and now, God forbid, you have a spouse that has to go into a full-time facility young, $128,640, especially if you're limited to say $3,200 a month in income, you may have to live on a pretty tight budget. And I'm not sure if most people who saved their money were really thinking that's how they wanted their retirement to be. Finally, a few states allow the community spouse to keep up to this full maximum amount, regardless of whether it's more or half of the couple's combined countable assets. So the really, the 128,640 is in the more generous states. So as it turns out, what Medicaid considers countable and non-countable assets when you're alive is different than when you're dead. And that's because after you passed away, they have something called estate recovery. And it's this process that they use to be able to recover more assets than they could when the person was alive, which means that both exempt or non-countable assets while a recipient was living are not necessarily protected in the future, because upon their death, Medicaid reserves the right to take from the estate the amount it paid for their care while they were alive. Let's take a look at the rules for that for a minute. So when it comes to estate recovery, here are the rules and procedures. Recovery of assets from an estate may be made first after the death of an unmarried Medicaid recipient, after the death of the surviving spouse, when the Medicaid recipient has no surviving children under the age of 21, when the Medicaid recipient has no surviving children of any age who are blind or totally disabled. Basically, this process was created to ensure that Medicaid gets every single dollar it can get from your estate once you and your dependents are gone, which, given the cost of long-term care, is not really something that you can blame them for doing. However, if you are interested in leaving a legacy of any type to your children or heirs, it definitely makes sense to plan in advance to do so. Okay, now that we've discussed all the rules and restrictions when it comes to receiving Medicaid-based long-term care coverage through the state and federal governments exclusively, let's discuss some of the incentives that the government has to offer to people who have gone the extra mile to put a plan together to help pay for their own long-term care needs. In 1992, the first long-term care partnership program started. It was called the Qualified State Long-Term Care Partnership Program, and it originated in 4 states: California, Connecticut, Indiana, and New York. It was a partnership program developed between insurance companies and state governments to find a solution to the problem of the ever-rising long-term care costs. It's a program that exists because leaders in government, the insurance industry, and consumer interest groups came together to solve the long-term care dilemma that has grown to become a major budgetary stress on our state and federal government's balance sheets. However, in 1993, the Omnibus Budget Reconciliation Act, also known as OBRA, prevented the expansion of these programs to additional states. But then in 2005, the Deficit Reduction Act, or DRA, was passed, and many states were able to start to develop their own long-term care partnership programs between insurance companies and state governments. Here's how they work. A partnership program that joins a state's Medicaid program with private insurance companies that offer long-term care insurance policies. The state's Medicaid programs eligibility requirements are adjusted to provide financial incentives for residents to purchase private long-term care insurance coverage. Now, if the insured requires long-term care services and their long-term care, their private long-term care policy pays out its benefits, then in the event the insured continues to need care after the policy's benefits are exhausted, or the cost of his or her care exceeds the policy's benefit level, he or she can then apply for Medicaid. And get this, then the standard asset limits that the state Medicaid program would otherwise impose on them, that's that 100 from 25,700 up to 128,640, do not apply to them anymore. So that's a major incentive. They're basically saying that if you get long-term care coverage, they're not going to make you have to, they're not going to make you have to leave all your assets unprotected. Now, this means that you or your family are going to be able to keep assets equal to the amount of the benefits that your long-term care policy provided. So for example, if you had a long-term care policy that provided $200,000 in long-term care benefits, that means $200,000 of your assets would be protected from you or your family having to use it to pay for long-term care. That means that once that policy then, once your policy then either expires or is used up, if indeed it does, all the benefits are exhausted, now the state will immediately kick in and they're not going to go after your estate until you get past that $200,000, which is pretty cool. Now, so this is great news for people who would like to protect their assets for their spouses and their heirs in the future from a catastrophic long-term care situation. At the same time, put themselves in a position to pay for most, if not all, of their long-term care needs. Note, and this is just something that I want to throw out there. I couldn't find it a place in any of the documentation to fit this in. So, side note, I do want to mention one important fact that is not well advertised when it comes to qualifying for Medicaid-based long-term care. And that is that not all nursing home facilities accept Medicaid coverage. So you must attain service from a long-term care facility that does accept it. And sometimes they can be in areas that are more inconvenient for your family to visit. And they may not be 100% up to your standards, depending on what your personal standards would be for yourself. But for the most part, they are pretty well taken care of. So now that we discussed most of the challenges when it comes to long-term care and how our state governments have incentivized us to do something about it, now let's discuss some of the solutions that I've come across that I find to be the most helpful when it comes to it. Here are the most popular types of long-term care solutions for you to consider and why. First is what's called standard long-term care, a standard long-term care policy. And this is the type of policy that most people know and heard about, where you pay X amount per year and you're guaranteed a certain benefit amount per month for a predetermined length of time. We'll look at how this plays out and the pros and cons of this type of solution in a minute. Second, something called long-term care / life insurance. It's a long-term care / life insurance hybrid policy. And this is a combination of both long-term care coverage and life insurance. And it'll also allow you to pay a certain amount per year for a predetermined amount of long-term care benefits every month. but it also will allow your beneficiaries to receive a lump sum payment if you don't ever use the policy or if you only collect from it partially. I personally think that this is attractive because many people don't like the fact that when you pay into a standard long-term care policy, if you pass away prior to using it, then your beneficiaries don't receive anything. So it seems like you wasted your money over those many years. We'll also take a look at that and how this works and at the pros and cons of this type of solution too. The third is a long-term care annuity insurance hybrid policy. Now, this hybrid solution works very close to the same as the long-term care / life insurance solution, except that it's usually funded using either a cash or non-qualified assets or another non-qualified annuity. Then, once the funds are in the annuity, then a long-term care rider is added to it that will provide X amount of long-term care benefits over a certain period of time after the base principal assets are used up for long-term care. This is usually used when an applicant has more substantial health issues and can't qualify for the long-term care / life policy, because it's a good bit easier to get because there's no life insurance involved. Now, finally, is what's called a Medicaid compliant annuity, which allows a Medicaid applicant to lower his or her countable assets down enough to meet Medicaid's asset limit, which is between, like I said, $2,000 and $3,000, which it is. I'm not exactly sure. It's up, I suppose, to the option of the state as well. But it allows you to lower your assets by converting the assets into an income source that then can be used towards the Medicaid applicant, or in some cases, the non-applicant spouse's income limit rules, which are generally much more generous than the asset limit rules. So now let's take a look at how these solutions work and at the pros and cons for them. So starting with the standard long-term care policy. Like I said before, you're going to pay X amount per year and you are guaranteed a certain benefit amount per month for a predetermined length of time. For example, I have clients who had these types of policies before we met, and they were paying roughly $3,000 a year each, and they needed to use had they needed to use it, they would have received right around $5,000 a month for 3 years for each of them toward their long-term care expenses before the policies ended. However, if they had passed away before ever using the policy, it would become null and void, and they would have ended up spending the money on it just for the peace of mind that they got to enjoy while they were still alive, which I don't think you should completely discount. Now, the reason we ended up reviewing their policies this year is because they, out of nowhere, got a notice in the mail saying that after 8 years of paying on them, their premiums were being increased by 44%, starting on the anniversary date. The wife's policy alone was currently costing about $120 a month. And so it was going up to $173 a month. And that's not to mention that it was likely that they were going to be continuing these increases as they got older and closer to actually needing the policies. So let's look at the pros and cons for the standard life long-term care policy. Pros: very affordable at first. The monthly benefit amount is definitely good compared to what they cost. They usually qualify for the state partnership programs. They pay for home health care, assisted care, and nursing home care. Premiums can be tax deductible if you're still itemizing, which most people aren't. But it's for any amount that's over 10% of your adjustable gross income. So for example, if 10% of your adjustable gross income is $10,000 and you're paying $13,000 for your premiums, then you're going to get the write-off $3,000. Also, the benefits are non-taxable or tax-free, which is great. Now, the cons. The premiums are susceptible to increases indefinitely, and you can't get away from that. The benefit periods are finite. You could need more, you could end up needing more care than they actually pay for and could still end up needing Medicaid program at some point. Now, also, if you die, like I said, you never get anything for your money except that peace of mind that you had when you were still alive. Now, let's look at the long-term care life insurance hybrid solution. Premiums can be paid periodically in a lump sum single premium. Benefits can be either for a certain period of time or over a lifetime, depending on how it's set up. It has a death benefit that will return all or most of the premiums to your beneficiaries when you die, tax-free. Policies are usually owned jointly with the life insurance paying out when the second insured passes away. Both insured can receive benefits of the same amount for either the same period of time or for a lifetime, and even at the same time if they end up in a facility or needing some type of long-term care at the same time. So, as an example, recently clients of mine have committed to moving $150,000 of their assets into a long-term care life plan. She's 66 and he's 65. And once they're approved, they'll both be covered for $5,000 a month each for the rest of their lives, regardless of how much care they need or what type of care they need, or another client of mine, or even what kind of care they need. And then there's another client of mine, as another example, she's 66. She pays $591 a month, and she too is covered for the same $5,000 a month of tax-free income to pay her long-term care costs for the rest of her life as well. Now, plus, if any of them were to die without using the policy, or without using at least the amount they put in, their heirs receive a death benefit, either at the invested amount or around 80% of it tax-free. Now let's look at the pros and the cons of this solution. Pros: the premium's a fixed amount for life that can be paid either monthly, quarterly, biannually, or annually, or even in a single lump sum. Benefits can be either for a set period of time or for a lifetime. It pays for just about all types of elder care expenses like home health care, assisted care, nursing home care, hospice, and even adult daycare. All or most of the premiums can be returned to the beneficiaries upon death if the long-term care policy is never used. Full benefits can be paid to both insured at the same time indefinitely. The long-term care portion of the premium is tax deductible. Again, over that 10% of adjustable gross income. And all benefits are paid out tax-free. Now, the cons. Well, the cost, it costs roughly 2.5 times more for the lifetime benefits. So if you want to be covered for benefits for your entire life, regardless of the different types of benefits, like what could happen these days is a person could be receiving home health care for 3 or 4 or 5 years before they end up going into a full-scale facility, and they could end up actually collecting for 10 years on something like this, depending on how long they're in, or if they're in a facility longer than the average person, another 5, 15 years, whatever it is, it will pay for the whole time. Now, so because it doesn't increase ever the cost, it costs a little more up front. Now, if you want to, the cost is roughly about 1.5 times more for the non-lifetime benefits than a standard lifetime long-term care policy is. So if you set it up to work just like a long-term care, a standard long-term care policy, which it can be, it's still going to cost a little more, about 1.5 times more, because the premiums are set in stone and can never be increased. Now, let's look at the long-term care annuity insurance hybrid solution. It's usually cash or non-qualified assets that are used to fund it. But qualified assets can be used if needed. It's a little trickier. Long-term care rider is added to it to provide X amount of long-term care benefits over a certain period of time, or even for a lifetime. Underwriting is minimal due to no life insurance involved. And it's usually applied for when an applicant has more substantial health issues and can't qualify for that long-term care life policy. So essentially works the same way as the long-term care life policy. But since there's no life insurance involved, there's no, the death benefit would only be what's the remainder of in the annuity if the person dies without using it, or only using it partially. However, the long-term care benefits will be paid. They can be set up to be paid for a whole lifetime, and they still would be paid, or they could be set up to paid for over 3 years or 5 years, however you want to set it. So there's a lot of flexibility in these plans. Pros: premiums are fixed amounts, either periodically or in a lump sum, so they never go up. Benefits: second, benefits can be paid either over a set period of time or for a lifetime. So you can actually receive whatever it is you're getting a month towards the long-term care cost, either over certain periods of time or even for a lifetime, depending on how you set it up. And believe it or not, the lifetime benefits are not far off in terms of their expense of what the periodic ones are. So it also pays for most types of elder care, including home health care, assisted care, nursing home care, hospice, and adult daycare. All or most of the premiums can be returned to the beneficiaries upon death if the policy is never used. Full benefits can be paid to both insured at the same time if there's 2 people on it. So in other words, if 2 people are in need of care at the same time, they'll both collect the same long-term care benefit for as long as the policy is set up for. The long-term care portion of the premiums is tax deductible. Again, for any amount that exceeds that 10% of adjusted gross income. Now, since it's an annuity, there's a base benefit of whatever amount you put into it. And if that base benefit is used to pay for long-term care expenses, even though there was growth on that from another type of a non-qualified investment, they're actually, based on the Pension Protection Act 2006, they're actually allowing people to utilize that growth to pay exclusively for long-term care needs tax-free. So you're not have to pay on the gains if you use it for long-term care needs. Now, all the long-term care rider benefits, once you use up all of your own money, that base protection, they all come out non-taxable. So they're all the pros. The one con that I find to this is it costs roughly about 8 to 10% more than even the long-term care life plan, that hybrid plan that I showed you before this. So it's even a little bit more than that. But again, it will provide a long-term care benefit to someone with very little underwriting needed. And it could be set up to pay somebody for a lifetime. So that's pretty substantial for having no underwriting. Now, finally, this last solution is not actually a solution that was made to ensure the costs of long-term care expenses like those first three were. Rather, it's for someone who, for whatever reason, did not or could not plan in advance for them to be covered by long-term care insurance. So they didn't plan to set up a long-term care, private long-term care insurance plan for themselves. But now they get to the point of needing long-term care and they're going to apply for Medicaid. And now they're faced with needing to these long-term care expenses to be paid at least partially by Medicaid. So it was created for them to be able to avoid having to spend down the lion's share, all but $3,000, $2,000 or $3,000 of their assets in order to meet Medicaid's long-term care qualifications. Uh-oh. So, sorry about that. It's called a Medicaid compliant annuity, and it allows a Medicaid applicant to reduce some or all, depending on how much they have, of their countable assets, thus allowing them to meet Medicaid's asset limits of that $2,000 to $3,000. It does this by converting those assets into an income source that can be used towards Medicaid's applicant, toward the Medicaid applicant or non-applicant spouse's income limit rules, which are currently $2,382 a month for the applicant, the Medicaid applicant, and between $2,115 to $3,216 a month for the non-applicant spouse. So, and as you can see, these income limits are much more generous than the asset limits rules are, because they're only allowing you to keep $2,000 to $3,000, period, when they're allowing you to have income of somewhere between $2,000 and $2,300 or $2,100 and $3,200 a month, especially for the non-applicant spouse. That's a big deal. This is because most assets, even retirement accounts in some states, that are actually owned separately by each spouse are considered jointly owned by Medicaid. Let me say that again. So it's because most assets, even retirement accounts, IRAs, 401ks in some states, that are actually owned separately by each spouse are considered jointly owned by Medicaid. So both applicants' assets are being taken into account when they're trying to qualify somebody for Medicaid. Okay, so since income is not, this is what makes this type of annuity such a great option. It converts non-exempt assets into non-countable income for a Medicaid applicant, or, and this is most importantly, or their non-applicant spouse. So, for instance, if the spouse was a stay-at-home, mother, did not pay much into Social Security, doesn't have much income coming to her as a result of that, but the applicant spouse saved a lot of money and had a lot of income, and say they had a big 401k and that, and this is common. I see this. So all the income, with the exception of half of their Social Security, is dedicated to the applicant spouse. What are you going to do if they're going to use all their income and all their assets to go towards, with the exception of somewhere between 25,000 and 128,000, they're going to allow the spouse to keep. So, for example, I did the numbers on this. You could convert up to $750,000 of assets into one of these Medicaid annuities, and it would turn up right around $3,200 a month in income. And you can divert that income to the non-applicant spouse, which is a big deal. So, and especially because Medicaid uses a concept which they call the name on the check rule. Whoever named that check, that income check is in, that's whose income it is. So you can set an annuity up, a Medicaid annuity, to have it, the assets come from the applicant, but the income go to the spouse. And that's done all the time. So that's why that's such an attractive a solution for a long-term care situation. So in a nutshell, here are some bullet points and pros and cons related to it. One, it can convert Medicaid countable assets into non-countable income. Two, it also is excluded from, here's a big one, the Medicaid 5-year look-back rule, because Medicaid goes back 5 years to see if you switched any of your assets into other people's names. And if they found that you did within 5 years of the time when you applied, those assets are going to count towards your countable assets. So you can't get it away from them if you do it in 5 years or less. Okay. But this type of solution actually is excluded from that rule. So it must be set up to pay out the full amount, though, of the annuity over the Medicaid applicant's life expectancy, which is based on government mortality tables that are actually used. So you can't, the non-applicant spouse can't collect it over her lifetime. She has to collect it over whatever the life expectancy is of that Medicaid applicant. It must start paying out immediately. It can convert roughly up to, like I said, I did the numbers, about $750,000 of assets, of countable assets, into non-countable income, depending on the income allowed by the state for a non-applicant spouse. And finally, it can be funded by either qualified or non-qualified assets, depending on the state's income rules for spouses. That's actually a big deal too, because qualified assets are exclusively in one person's name. So, but if it's converted to this and the income's paid out to the spouse, it can actually qualify. So here are the pros and cons. One, they provide an opportunity to retain access to your money as income in place of using it to pay for long-term care expenses. Two, it can be used to provide income to a non-Medicaid applicant spouse up to the spousal income limits. And three, again, like I said, the 5-year look-back rule is completely avoided and not not used for this purpose. Cons: payout schedule must be based on life expectancy, not for the whole life, not for your whole life. That's something that's a little bit different than we usually see with annuities. Two, the income payments are included with Social Security, pensions, and all other income sources up to the Medicaid limits. So if a non-applicant spouse has a $2,500 a month Social Security payment of her own, then you could only convert enough assets, possibly if they allow you to go up to $3,200. So it does have its limitations. The portion of your assets that can be protected are limited by other income sources and the Medicaid income limits. So it's really great in a situation where, say, a non-applicant spouse doesn't have a lot of income choices. Then you can convert the most assets. All right. Now, folks, that concludes the informational part of our workshop today. But before we jump into our 6-question quiz and our Q&A for it, I want to make a very special offer to everyone that is attending. I want to offer everyone here with us attending today a complimentary long-term care plan analysis. And I want to take a minute to explain a little bit about what that entails and what you can get out of it. So this is what it entails. First, there's 2 ways to actually do it. The first is online using Zoom, which is almost like how we're doing this webinar, but instead we'll both be able to see each other and hear each other, and it'll be completely private. Also, the other way, we can meet in person at our office in Fort Washington. It's just off the PA Turnpike. The second part of our process is we would meet to gather one time to gather all information that I'll need to do the analysis. And then we would meet a second time to go over the results of the analysis. And finally, what you can get out of this is a clear understanding of whether it would be worth it or not for you to implement one of the long-term care plans that we discussed today. And this is how we find out. So yeah, this is how we find out at the end of our analysis whether it would be worth it for you or not. So once I have all the pertinent information, I'll put it into my retirement planning software, which looks like this. These are the actual screenshots from inside my software. I have to put into it stuff like your name, date of birth, planned retirement year, your Social Security retirement income, pension information income, investment account totals and potential returns, your projected tax rates, and several different data points that we really need to really expenses and all your income sources. Then once all that's entered into the software, then we can compare various scenarios pertaining to the different long-term care plans that I showed you to earlier, to either your current long-term care plan, if you have one, or your plan without a long-term care plan in it, if you don't have one. Here's an example of a client of mine that I just started the process for recently. The graphs in the green are screenshots from different scenarios that we have compared. The top graph shows that their current financial situation, which does not involve a long-term care insurance plan, and they currently have $960,000 in assets. When you include some income-based annuities that they have on top of these assets. In this scenario, they would both end up needing 3 years in a full-scale nursing facility prior to passing away. As you can see, their assets begin to deplete pretty quickly, and they only have an 82% chance of successfully meeting their financial obligations up until their life expectancy, which is 82 for him and 85 for her based on government mortality tables. Now, the middle scenario is the same as the above, except in it, they transfer $150,000 of their assets from an investment annuity that they already have to a long-term care life solution like the one I showed you. As you can see, it took them from an 82% chance of financial success to 100% chance of success up until their current life expectancies. Again, which is 82 for him and 85 for her. Now, the bottom graph is the same as the middle situation where they implemented the long-term care plan, except that it also includes an additional 3 years each of home health care at $50,000 each for each year for both of them prior to entering the full-scale nursing facility each. Now, even though it does not cause the situation to slip, it does cause their situation to slip a little, they still end up having about a 97% chance of success after paying for essentially another $150,000 worth of long-term care added to each of their lifetime. So, as you can see, this is a situation where they were able to just move some assets from one type of investment to another. And by doing so, they end up with completely different results. And they can do this because they plan things out prior to running into what could have been a catastrophic financial situation for them and their family. Now, with all that being said, I normally charge $749 for this type of analysis, but I've decided to offer them complimentary just for everyone on this webinar today. All you have to do is schedule the first meeting of the 2 meetings tonight before midnight, and Rachel's going to put up a 60-minute meeting link to my schedule for you to do that now or until midnight. I'm going to leave this webinar up so you can go in and access this link after it ends. So you can copy and paste it or click in it and schedule whatever you want to do. I'm going to leave it up for about a half hour after we end the workshop. However, if for some reason you can't schedule before then, or you're kind of analytical like I am, and you decide you don't really, you want to think things through a little or find out a little more information, I'm definitely willing to offer you guys a 60% off for the next 3 days for anybody who will schedule within the next 3 days. Now, Rachel's also going to put up a 15-minute Q&A meeting, Zoom meeting link. If you want to talk about a few things then find out a little more information before you book, and you want to schedule a 15-minute Q&A meeting with me, and then we can talk about it. If you do that and then you make your decision to do it, I'll still do it complimentary for you. Now, with that said, Rachel's going to put up the link to my calendar in our comment box right now. And as an extra bonus, if you sign up before we end the webinar, we are not only going to offer you the analysis complimentary, we're going to give you a $25 gift card to your favorite store after we complete the analysis for you. And we're doing this as part of a new PLC Financial Solutions Awareness Program that we're launching in order to get our name out there to people. So we're really kind of launching a multi-level promotional program starting really December this year, but really the main thrust is going to be starting 2022. So as we're doing our 6th question pop quiz and our Q&A session, anyone who's interested in taking us up on this offer, you can start booking dates with me on my calendar. Also, while you're booking the date, you'll see a box that says, please share anything that will help prepare for our meeting. In it, please write in that box the words free long-term care meeting, free long-term care meeting, and we'll know that you were part of this offer. So, all right. So now that we have all that out of the way, let's start our 6th question pop quiz and our Q&A session. All right. So, first question. You're going to keep me posted on these, Rachel? First question. How much is the current cost for a single occupant private room at a nursing home per year? How much is the current cost annually for a single occupant private room at a nursing home facility? Any answers there, Rachel?
Yeah, it looks like Bob says 102,000.
That's pretty darn close. That's almost dead on. Anyone else? We'll give it 5, 4, 3, 2, 1. Oh my goodness. Lesha got the exact number. $102,200.
That was a buzzer beater.
That was. Sorry, Bob. Although Bob's always he's usually winning. All right. Second question. What does Medicaid call the process of one depleting their own funds to become eligible for assistance? We only said it about 10 times in the beginning. Yes, Bob, spend down. Good one. Okay. Third one. How much is the nominal amount of income that a Medicaid recipient is allowed to retain each month? It's a range. Anything in between the range, I'll give you. That's actually, now I'm glad you put that up there, Lesha, because that's actually the income limit to be qualified. It's actually a difference than the amount that they allow you to actually keep every month once you do qualify.
Oh, looks like and fee says
Remember I said it was a
2,000 to
nominal
3,500.
amount.
And fee says 2,000 to 3,500.
$30 to $50. Yes, good one, Lesha. That's right. I don't have to expect anybody to live on that, but that's it. All right. Fourth question. Name one form of income not counted toward your income. One form of income. There was 5 that I read out. Food stamps. SSI. That was, I'm going to give both Ann and Bob that one. P certificates. What was that? We're going to give it up. Sorry on that one, Lesha. I don't see one like that. But Bob and Ann both got that correct because they were both 2 of the 5. All right. This is number 5. What is the max amount of assets? Now we're talking assets, not income. A Medicaid recipient can have to be eligible. Now we're talking about the recipient, not the non-applicant spouse. What is the maximum amount of assets? Yes, that's right, Bob. Lesha was on the track too. You have them 2 zeros out. Bob got that one. Damn, Bob, you're right. You must be writing all this down. All right. Final question. What is the process called that Medicaid goes through in pursuit of reimbursement after someone passes away? What's that process called? Ooh, close, Bob. Yes. Lesha got it. Estate recovery. So we're going to actually, for everybody who got multiple questions, we're going to add $10 to each of them. Now, do me a favor. We could do it quickly now, but put in the comment box is the store that you would like the gift certificate from. Bob says Walmart, Rachel. Lesha, Ann?
Yep, we need Lesha's and Ann. Target.
I like that. I was just going to say that. So everybody knows. I think Walmart might be one of them. I'm not sure, but I think it's Target. It might be Target and Walmart. The two of them will allow you to actually send them through email. How about Amazon? Last year, oh no, it's Amazon and Walmart and Target allow you to email. I can email you them. I think Bob, we did Walmart the last 2 times, and they had actually sent a manual card. Is that correct, Bob? Through the mail?
Yeah,
Got
okay,
that
Lesha
on
says
my-
Target.
Okay, you're gonna go with Target. Okay. All right, let's open it up for questions. And any questions in the comment boxes?
Yeah, let's see, there's a couple here. Oh, I see Lesha put her one answer in there first by accident. So let's see, I think this was back when you were talking about the what qualifies you for the long-term care services. So Lesha said, so those who work hard and their incomes get taxed for long-term services are the ones who do not qualify for any of the help. Is that right? So if you make too much and you get taxed, and you also don't qualify for the help.
Well, it is true that, you know, there are certain income limits that most people have to qualify with. And like we talked about, I believe it's $2,382, the income limit for the applicant spouse. And then it's a range from $2,114 or 15 to $3,200 and some change for a non-applicant spouse. Generally, yes, it's true if your income's over that, but the tax, it's not really, it doesn't really play into that. What's it say? Are the very ones who do not qualify for any of this help? It is true, yes. If you're over certain income limits, you might not qualify. That's true. What do you have for the next one, Rach?
Okay, so the next one, Bob was asking says if I get a nest egg trust was irrevocable, will Medicaid try to recover the assets?
Yes, if it's in your name, or irrevocable. That is a good question, Bob. I'm going to have to look that up. If it's irrevocable, I don't believe, well, it may be for taxes, but for Medicaid, that is a good question. I will have to get back to you on that. I think that I'm going to shoot from the hip, Bob, and I'm going to say that I think that they may be able to, because Medicaid's not the IRS. That they may be able to go after that for Medicaid purposes, long-term care purposes. I know the IRS can't, but I will get back to you on that though, because that's a good one. All right, next one.
And next one says, is it too late to qualify for long-term care options at age 66 or for someone with significant health issues?
No, it isn't actually. Most of the clients that apply for this are somewhere between, retirement age, anywhere between 62 and 68, I'd say, or 70. Obviously, when you start at certain ages, I believe there are certain long-term care options on private health care or long-term care plans can go up, some of them as high as 85, but they're for really, really, specific types of situations. But health issues, believe it or not, in this type of, you got to think about it. Their concern is for you living too long to a certain degree, right? Because if you're in a facility, the longer you live, the more they're going to pay. So it's like life insurance. But so they want to, but when you do have the life insurance combination of the two, it definitely will play into it, and it could preclude you from getting that type of plan. But the long-term care annuity option is much more lenient, and you see people with some pretty serious illnesses that are getting it. Actually, I was at a workshop with one of the companies, and they were talking about how aggressive they are, probably one of the most aggressive in the country at getting people passed through underwriting. So they really work hard with this type of insurance to get people passed. So you'd be surprised the type of health issues you can actually pass. Anything else?
Yep, it looks like there's one more. Says, my wife and I own a home. If I go into a nursing home and Medicaid pays for my care, will they go after our home when I pass away?
No, not if your wife is still living there, but they will, or if you have a child under 21 or a disabled child that's living there. But if you don't have that, what they do is they go after the home once your wife passes away. That's part of the recovery process. All right, is that
okay? Yeah, that looks like that's it.
Okay, so hold on a second. All right, so Rachel's also going to put up all of these sources that I used for this presentation. A lot of the things I talked about, you can find all the details in these sources. So she's going to copy and paste, put them into the comment box. If you want to copy and paste them out, all of them are links that you can put into a search engine and look up online. So, all right, folks, that concludes our workshop for today. I just want to thank everyone who attended for being the type of people that care enough about themselves and their family to spend their precious time learning about this important topic. I truly commend you for that. So, on behalf of my beautiful, wonderful partner in life and business, Rachel Dougherty, and myself, Brian Dougherty of PLC Financial Solutions, located in Fort Washington, PA, in the Fort Washington, PA area, I want to remind you that if there's anything we've discussed tonight, or anything else for that matter that you'd like to discuss further with us, you can reach out to us at either 215-804-9708 by phone, or at info@plcfs.com, or to make it even easier, and Rachel, I guess, can put this in the comment box, you can go to our website at plcfs.com, and all our information is always there, and you can contact us and figure a way, whichever way you'd like to contact us most, there at all times. So also, please mark Tuesday, December 28th, 2021 at 7 p.m. on your calendar for our next webinar. Remember, we do them on the last Tuesday of every month. So have a great holiday season, and we'll see you guys then. Good night, folks.
Have a great night.